just want to share some economic data with you. It's stuff we like looking at to try to make sense of the economy. I'm just going to minimize myself over here. So I'm going to start with some US data. And the reason that I'm going to start with some US data is that the US is the world's biggest economy. We're their neighbor. We are highly influenced by whatever happens in the US. And here in Canada, our monetary policy, so our Bank of Canada, will typically just mirror whatever happens by the US Federal Reserve and whatever is going on in the US. So, if we can get a handle of what's happening in the US, it often gives us some clues to what's going to happen here in Canada and how we're going to be affected here in Canada, and how things like our income properties and real estate prices may or may not be affected here in Canada. It gives us some clues into what's going to happen. So I just want to start with a little bit of a historic look at property prices in the US. Here's a chart going back many decades, but if we focus in around this environment here, you can see property prices before the US financial crisis peaked in 2007. Then they came down, and it looks like they kind of hit the bottom around 2009, and then they went up, and it took a few years for them to kind of match their previous level. So it looks like it was a full cycle of about 5 or 6 years. And then since then, property prices in the US have continued to go up and have gone up past their previous highs. And in order to do that, what the US government had to do was cut interest rates really low, and they kept them really low for pretty much a decade. And they put a lot of stimulus into the economy, right? So some of that was through what was called quantitative easing. Some of it was through some other direct stimulus packages to try to get the economy flowing again. And that created a lot of new debt in the US. And that's something that I want to take a look at to see if we can get any clues as to what might be in our future. So here's a chart of the total debt in the US, and it's currently at $23.2 trillion. And you can see in 2007, at the peak of the housing market before the financial crisis hit, it was at about $9.2 trillion. So it went from 9.2 to 23.2, which is a difference of 14 trillion, or about 150%. So that's interesting to us. But what's also interesting is that if you look, these little gray lines here on this chart, these are different recessions. And obviously, we're in a recession right now. I don't know if that's a big surprise to anyone. The economic data is not out. We don't see it yet. We don't see the 2 quarters of back-to-back negative growth that will kind of like define a recession. But let's face it, we all know that we're in a recession right now. I don't think it's any big surprise that we're in an economic recession with the health pandemic that has swept the world and basically got the economies around the world to all, I can't even believe I'm saying this, to all kind of stop and sink. It's kind of crazy. So it's just almost unbelievable to think about it. But anyway, in 1990, there was this recession, and you can see that the US debt after that recession kind of continued to march upward, and it marched upward at this pace on this chart here. But then you can see after the next recession, that's kind of like the recession that was right after the NASDAQ kind of tech bubble that burst. Debt continued to go up in the US, but it went up at a faster pace. You can see how the slope of that line changes, right? And then there's the US financial crisis. And the US financial crisis occurred, and debt continued to go up, but the slope of the line has continued to go up at a higher pace. It's at a steeper angle here. So my question is that if you just on some basic math say that since the last recession, US debt went up 150%, just to match that means it's going from 23 trillion to like $55 trillion or something like that, to recover from this recession that I think we're currently in. And if the line goes at a steeper angle, that means a lot of that money, that new stimulus, is going to be stuffed into the economy at an even faster rate. Because this line, to go steeper, if the same trend was to hold, that it goes steeper and steeper after every recession, it's going to go up kind of like something like this. And I know you're just looking at my mouse here. I don't actually have a line, but it's going to go up much steeper. And if you look at the far left-hand side here, we're at 24 trillion here on this chart in the US. Imagine it at 55 trillion, but not just at 55 trillion, that it hits 55 trillion at a much faster rate than it ever has in history. What is that going to do to A, the value of the dollar, the US dollar, then there's the trickle down effect, the value of the euro, the value of the Canadian dollar, as all other economies try to match what the US is doing and shove stimulus into their economies and print more dollars to do it. So the value of the dollar, and then the price of good hard assets. And this is something, if you're new to us, you may not know this, but if you've been around for any length of time, we're big believers in having some part of your family's wealth in hard assets, because hard assets are one way to protect your wealth as a family in environments where there are low interest rates and lots of money printing, lots of stimulus, and lots of new debt. So it looks to us that if we just look at some basic charts here, that we think there's going to be a lot more debt coming at a much faster rate than ever before. And part of the reason that we think it really is going to happen this way is, check out this. Let me just move my little video thing here. Look at this article that we found on the Financial Times. It says banks stand to make billions from U.S. small business rescue. Take a look at this paragraph that we've highlighted here. Banks will receive processing fees paid by the federal government for making the loans. The fees will vary with loan size: 5% for loans under $350,000, 3% for loans under $2 million, 1% for loans greater than $2 million. This means to us that the banks are going to be profiting from taking new debt from the government in forms of stimulus and pushing it out to small businesses. The banks are actually going to be compensated quite handsomely for this. And that's fine. We can all argue if that's right or wrong. I'm not here to do that. My point is, the fact that these are in place, I've been in sales environments my whole life, and I know when there's a compensation plan in place, and this is what this looks like to me, a compensation plan. When there's a compensation plan in place, the people who benefit from that compensation plan are likely going to do everything in their power to maximize it, which makes me think that this is a clue that all the stimulus that's going to be announced from the US government, they announced $2 trillion and then $4 trillion in a form of liquidity for the financial system. They're going to be pushing that money out as fast as humanly possible because they're going to be profiting from it. So our whole idea that there's going to be more debt at a faster pace, maybe this is a clue that that's actually going to take place. And I mean, we have no crystal ball for sure, but it's somewhat interesting. Now let's flip over to the Canadian banking industry. And here is our Bank of Canada here in this country. This is their website. And I pulled up overnight lending rates from the last 10 years. And the reason I like to look at overnight lending rates is because that's the rate that ultimately kind of sets the bank prime rate in this country. And if you have a variable rate mortgage, your variable rate is tied to the bank prime rate. So for example, the bank prime rate now in Canada as of today, April 1st, is 2.45. The big banks are typically at 2.45% right now. So if you have a variable rate mortgage and your variable rate mortgage is prime minus 0.6, that would be 2.45% minus 0.6. You're under 2% with your mortgage right now, which is just crazy to think about. But that's where you are with your mortgage rate. You're under 2% if you have a prime variable rate mortgage that is prime with some sort of discount, right? If you have prime with no discount, you're right at 2.45%. If you have a prime plus variable rate, you're slightly higher than 2.45%, but that's how the variable rate mortgages work in this country. And you can see that the Bank of Canada's overnight lending rate, back in 2010, it was really low because they had cut it during the US financial crisis because we mirrored what the US did. Even though we didn't have such a big crisis here in Canada, our monetary policy always mirrors what the US does. It's why we look at the US data. So we were down really low, and then they started moving it up. And you can see in 2010, they moved it up a little bit, but then in 2015, they actually cut it a little bit. And then in 2017, they did a couple increases. Then in 2018, they did 3 increases. And then over the last 30 days, they did 3 decreases, each of 0.5%. So on March 4th, on March 16th, and on March 27th. So just in March of 2020, which is almost unbelievable to me. And for anyone who knows us, we've been kind of looking at this stuff for a long time. They cut it 1.5% in 30 days, which to me means the government fully believes we are in a recession right now, and they're doing everything in their power to try to thwart that and make money cheap so that the economy has a chance to get some action and some money flowing through it. They're trying to make it as cheap as possible. It's at 0.25%. I believe they said that they're not going to cut it anymore. I think they're going to go right down to 0, but who knows? They might just further stimulate the economy with more stimulus announcements. And in Canada here, we don't have savings, so that'll be more debt into this country as we put out more stimulus into the economy. And when we look at some of the Canadian articles, there's this article here that says this COVID-19 aid bill that Canada has announced really included in it some interesting things that gives the government some power. One of the things here says that the original draft of the bill offered some unprecedented power to our finance minister. And it says here, most notably, the power to increase, reduce, or add taxes without Parliament's approval until December 31st, 2021. That's a pretty big whip. If the finance minister can increase, reduce, or add taxes without Parliament's approval, that's a pretty powerful measure. But that's not really what caught our interest. What really caught our interest was this paragraph right here. Let me highlight this. This paragraph here says there was also a growing frustration within the upper ranks of the Liberal government over concerns that banks had declined to loosen their lending standards. I just want to repeat this. The government was upset that the banks declined to loosen their lending standards, even as Canadian families and businesses struggled to gain access to the capital they need. This is some insight into the highest levels of our government and the highest levels of our banking industry. And the reason I find this very insightful is that I feel in this environment, and especially over the next few weeks and months, I can totally see the banks continuing to tightening their lending standards as they have some uncertainty in the world and they're trying to protect their interest in their business. In fact, yesterday we saw one of the major Canadian banks announce that you no longer can use HELOC money as the down payment for the purchase of rental properties. So that's new. That's them tightening, and we expect more of those kinds of announcements. But on the flip side, and here's what we think is going to happen in the medium and longer term, we think even though the banks might tighten some of their lending standards, the government is going to force the banks to lend money because they're going to want money to get into the economy. So they're going to force the government to lend money. And even if the banks tighten up some of their lending standards, we think that the government may trump them on that, and they might push money out, and they might almost force the banks to put out new lending into the economy as an effort to kind of kickstart the economy from the recession that we're currently in. So this is going to be a fascinating battle between the banking industry and the government, because the banks, let's face it, in this country, they're not scared of anyone. They're big and they don't really need anyone. However, the only people that do pose a threat to them is the government, because the government can impose new taxes and the government can impose new regulations. So if the government really wants to push them around, they can. And that little paragraph there is some insight. There's actually another paragraph here that says, others in the government did not share in that frustration, arguing that banks should not be asked to take on new and potentially unstable debts as the liabilities on the balance sheet swell. So when I read that, I'm like, oh my gosh, so they were asked? Like someone in the government did in fact ask them to take on some potentially unstable new debts? And if this is the way the government is acting right now, I really believe that as they try to get the economy kickstarted over the next, the medium term at least, the banks might be forced to put out some lending that maybe they don't even really agree with. So there's going to be this fascinating struggle. And the reason that we are so interested in all of this stuff, how much debt the US incurs, because we know that Canada will follow with very similar type stimulus packages, maybe not in size, but definitely in the type of stimulus packages that Canada puts out. And the reason that's important to myself and my family and Nick, and we feel it's important to talk with the investors that we work with, is that as more money gets flushed into the system through new debt, as new dollars are created, the value of the dollars in our pockets, the value of our dollars in our savings, the value of all of our incomes, like your income, the purchasing power of your income in relation to hard assets, those dollars are all going to be worth less. And what that means is, to us, is that you want hard assets in your life. Even in environments like this, we believe you want good income properties. And I know some people are going to roast me for this idea, this whole thinking. But I truly believe that over the medium term at least, because we don't, over the short term, there's definitely going to be some turbulence ahead. There's no doubt there's going to be turbulence ahead. We don't have a crystal ball for the short term. As things kind of seize up further from even today, we're recording this on April 1st, 2020. definitely property prices could come down in the Toronto and the Golden Horseshoe. Absolutely. But longer term, like medium term and even longer than that, we believe, in fact, the people who own hard assets are going to be able to protect their wealth and might actually be able to even get ahead for themselves and their families in this environment. And the reason for that is these stimulus packages are going to put so much money into the system that the value of the dollars, the value of incomes is going to be devalued to a point where hard goods, hard assets are going to be worth more. So we believe in times like this, you definitely want to continue to acquire good assets. And one of our favorite analysts on the economy is James Rickards. He's best-selling author of a bunch of books on this topic. This weekend, I actually put a tweet out to him, and I asked him, I said, hey, James, thanks for all your work. Question: in a world where the US devalues 50 to 80%, so the US dollar devalues itself by 50 to 80%, and the reason I chose those numbers, he mentioned it in one of his articles, is that I'm saying, is that in relation to literally everything, I assume? Groceries, property, rent costs. So just to repeat, in a world where the US dollar devalues 50 to 80%, is that in relation to literally everything? Groceries, property, and rent costs. Just trying to wrap my head around this. And I think I already knew the answer. I just wanted to hear it from him. So really what I'm asking here is that, does he believe the value of dollars is really going to drop tremendously over the medium and longer term in relation to like everything? Groceries we need to buy, rent that we need to pay for, property costs that we need to pay for, like the value of dollars in the economy, whether it's the US, Canada, the euro, anywhere around the world, is it going to drop in relation to just like absolutely everything? And his answer was yes. You can't look at other currencies because they're all in the same boat. You have to look at land, gold, and tangible goods. And it's why we talk about, good hard assets like income properties, especially things that pay for themselves, like cash flowing property. It's why over the last 10 years, we've been big believers in this. We believe in good times or bad times, you always want to have good hard assets in your life. And I really think going forward, this is something that we all should be paying attention to. And even as the banking system goes crazy, we're definitely going to see some crazy announcements over the next few months where they tighten up some rules, change some income requirements. But then the government's going to respond. I feel, again, we don't have any crystal ball. You're just kind of getting some of our own opinions on this, that the government's going to push through some lending, whether the banks want to or not. So we'll continue to share all this information as we get it. We just wanted to get that out to you as quickly as we could. Hopefully you're taking some value, or it's making you think through this. Look, Nick and I both want the best for everyone. We hope everyone's in great health and your families, and we're all doing as best as humanly possible. And even in these times, we want to be living life on our terms as much as we possibly can. And that's why we're just sharing this kind of information to hopefully in some small way give you something to think about. So that's it for now. Wishing you all the best during these times. And until next time, your life, your terms.